The advantages of the physical measure method are that it's very easy to use. The disadvantage is that it ignores the revenue producing capability of the individual products. We can get more money for tuna fillets than we can for canned tuna, for example. Method 2 is the sales value at split off. So this allocates joint costs to products on the basis of their relative sales values at the split off point. This method can only be used when joint products can be sold at the split off point. So after they're done with their first processes, their joint processes, they're able to be sold and they do not have to be processed further in order to become usable, sellable products. And this all depends on what kind of industry we're in and what we make. So in this example, we look at the sales at split off point. And the price per unit is the price at split off point. So we have tuna fillets and canned tuna. We have our price per unit and our sales value. So if we sell 2,000 pounds of tuna fillets at $2.20 per pound, we have sales value of $4,400. This gives us a proportion of 25% and 75%. So unlike the physical measures that were separated 20% and 80%, we would allocate based on their eventual sales value. And then that proportion changes to 25%, 75%. Disadvantages are that our market prices aren't necessarily constant. So it really depends on our industry. Much like the physical, it's very easy to calculate. We also have that sales price at split off might not be available because additional processing is necessary for the sale. So we can't sell the raw tuna in its current state, but we have to do more things to it in order to do that. The net realizable value method is used when joint products cannot be sold at split off. So this is used at its estimated sales value at the split off point. So we determine this by subtracting our additional processing and selling costs beyond the split off point from the estimated ultimate sales value of the product. So in this example, we go back to our joint costs are incurred for processing the tuna. We have split off point. We can do tuna fillets and canned tuna. We use those 4,000 pounds of scrap, as we saw in the physical method, if further processed, can become cat food. 3,000 pounds of that scrap can become cat food if further processed. It costs $850 to additionally process that. So when we look at the net realizable value, then we have that cat food with additional processing is also a possibility of creating sales value. So we take the net realizable value. So with the tuna fillets and the canned tuna, it's just the sales value because there's no additional processing. For cat food, we take the sales value minus the additional processing. In that case, we allocate those joint costs across 3 products. Instead of just the tuna fillets and the canned tuna, we also have cat food as an additional product. At the split off point, we often need to decide whether to sell the product as is at the split off point or to add the additional cost to process further and sell it for a higher price. Whether or not we do that depends on if the additional cost for processing increases the sales value from the split off point. So we have to know how much it costs additionally. So if the increase in sales value is less than the additional cost for processing, then we wouldn't take the advantage to process it further, and we would just sell it at its split off point. When we use the constant gross margin percentage method, we use this when it's desired to have each joint product after joint cost allocation and separable costs to have the same gross margin percentage. So this outcome gives us that each joint product will be equally profitable as measured by the gross margin percentage. And we'll work through an example of that in class. For byproduct costing, we have 4 methods. 2 are based on asset and 2 are based on revenue. So the asset recognition methods that we have are the net realizable value and the other income at production point method. The revenue methods are other income at selling point method and the manufacturing cost reduction at selling point method. The main difference between these methods is whether the byproduct is produced as inventory, and the second grouping recognizes byproduct revenue in the period sold. So we need to decide if we're going to recognize our product as inventory at its net realizable value, or if it's just something that happens as revenue in the period sold. We will also do examples of that in class so you can see what determines the factor. Sometimes that decision is made by the materiality of the byproduct.